Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Tesla continues to lower prices, announcing a new price cut just in the past week. The company's vehicles, particularly the Model 3 and Model Y, are now really compelling compared to internal combustion engine vehicles. Now, a lot of investors would think that this is a point of strength for Tesla, but I think this is ultimately really a point of weakness. And we can go back historically to how the company has priced its products in the past. So that's what I'm going to get to today. Exactly what a Tesla costs today, what we know about the company's sales and inventory, and then the effect that that's having on margins, because there's something that has to give here. And I think that there's more of a demand problem than a lot of investors want to admit. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to the Motley Fool for sponsoring this video. Check out fool.com/ASYM for their top 10 stocks to buy right now. Let's just start with what a Tesla costs today, at least at a starting point. This is a look at the Model 3, which you can see that the rear-wheel drive version starts at $38,990. And then in addition to that, we get the $7,500 tax credit in the US, along with any other state or local incentives. The Model Y starts at $43,990, again, on top of any other incentives. So pretty clear that the company is moving towards price parity with traditional vehicles. And that's something that Bloomberg wrote about this week. This is a really good article by Tom Randall, and he talks about the fact that price cuts have actually made Tesla very competitive with traditional vehicles, even like a Toyota Camry. But what this doesn't get into is the effect that it's having on Tesla's financials. And this maybe tells a little bit more of the story of why they're cutting prices. So let's go back to early in the pandemic. And you can see from this chart that Tesla has not always had a very low cost vehicle. In fact, Tesla's revenue per vehicle, which again does not include the tax credit, was $57,331 in the second quarter of 2022. That time period might ring a bell because that is when vehicles overall in the US were very undersupplied. Automakers had canceled chip orders, they couldn't get chips, make enough vehicles, especially small vehicles. That's why they focused on making large SUVs and trucks. That those SUVs and trucks are not really competing with Model 3 and Model Y vehicles. So $57,000 is what they averaged in the second quarter of 2022. A year later, Q2 2023, the average revenue per vehicle for Tesla, $45,626. So nearly a $12,000 discount over the course of 1 year. This is on average, but we have seen price cuts across the board for Tesla, and we're likely going to see those numbers decline even more after the third quarter. So what impact are these price reductions having on margins? Well, margins have dropped dramatically as well. Over that same period of time, gross margin excluding credits fell from 25.6% to 17%. You may think that a lot of cost reductions have gone into Teslas and that's why they're able to lower prices. But again, we don't see that. There has been about a $5,000 reduction in the average cost per vehicle over the last year, from $43,000 to $37,500. But again, that's not offsetting the cost reductions. As a result, the gross profit per vehicle, and this is just another way to put the percentage that I said before, but the profit that Tesla is making per vehicle has declined from a peak of $15,675 in Q1 2022, $7 in the second quarter of 2023. That number will likely decline further in the third quarter because of these price reductions. What is another reason to be worried about Tesla's demand? Well, production is not increasing at the rate that management has said that they would increase production. Remember, Elon Musk has always said that they want to increase production 50% per year, and they did that for a number of years. But over the past year, production has really stalled out. In the fourth quarter of 2022, production was 439,701 vehicles. That was essentially flat in the first quarter, went up to nearly 480,000 vehicles in the second quarter, and now again down to 430,500 vehicles in the third quarter. We do have those third quarter numbers, at least the production and delivery numbers. So production is flat, but prices are coming down. What does that tell us? That tells us that there is less demand than there is supply for Tesla's vehicles. Just simple supply and demand econ 101. That is what Tesla is telling us with their pricing. And I think investors need to listen. Now, why is there even more reason to worry about the future? Well, everyone is coming out with more electric vehicles. They're not all going to be successful. But General Motors, Ford, Volkswagen don't need to make money on every electric vehicle that they make because they make lots of money with other vehicles. Ford and GM, particularly, are making a ton of money on trucks and SUVs. Those are not products that Tesla has a competitive product with. The Cybertruck, will see what comes from that. But there isn't anybody shopping for a $40,000 third row SUV that is going to be looking at a Tesla versus a General Motors or Ford vehicle because they're just simply not comparable from a price point or size perspective. So I think what we have clearly seen is Tesla hitting the max of how much demand they have for their vehicles in the Model 3 and Model Y format, especially now that other automakers are starting to increase production of their typical internal combustion engine vehicles and then also ramp production of electric vehicles. So what are we going to want to watch in the third quarter results to see if indeed we do have a reduction in demand for Tesla's vehicles that's not being made up? Well, we're going to want to watch those gross margin numbers, the profit per vehicle numbers. If those continue to come down, what is going to happen as Tesla ramps up production in more facilities? If they build this Mexico facility, if they add the Cybertruck, what do you think is going to happen to margins and prices as production goes up? Let's say it is the 50% per year. Well, margins are going to have to keep coming down because we're now in a price war. Add to that BYD and a ton of other Chinese manufacturers are producing what we have seen as really compelling vehicles for both China and the European market. They haven't made it to the US yet, but everything we have seen is that the competition is getting a lot stronger. So I think there's just something here that's starting to break with Tesla. Demand is clearly not through the roof. You can now get a Tesla in a few days. There's plenty of inventory on dealer lots. Pricing continues to come down. This isn't just a one-time trend. This is a long-term trend. And it's telling me that Tesla is actually producing more vehicles than it needs. And it doesn't have the demand, the unlimited demand that it once had. We've kind of capped that out at this point. So we will see what happens in the third quarter. Look for management commentary from that pricing and margin perspective. What do they say about increasing production, which is clearly priced into the stock? Remember that this is priced as a growth stock. So if they're not making 4, 5, 6, 7 million vehicles per year a decade from now, that's going to be a huge problem for the stock's valuation. Add all of this up, and I just think there's a lot of negativity coming from Tesla from a operational standpoint. I don't know what's going to happen with the stock, but that's what I'm going to be keeping an eye on, is what's going on with the operations. So follow Asymmetric Investing for more on Tesla and the electric vehicle market. Don't forget to check out fool.com/ASYM for their top 10 stocks to buy right now. Thanks for watching, everybody. See you here next time.